Everybody, this is chapters 26 and 27, I believe, return on investment. And I just wanted to give you kind of a brief overview. I won't read through the chapter or anything like that. But a lot of people have heard the term ROI, or return on investment, but don't know much about it. So my first question is, what is return on investment? And my first answer is a pretty dumb one, because return on investment is exactly what it sounds like. It's the return that you earn on your investment. What that really means is that in business we often have to commit resources, usually those are financial resources, but not always, to projects and or to a portion of the business or to the whole business. And we need some easy way of measuring how much return we earn, or how much profit we make, or positive cash flow we make on our investment. So these two chapters kind of talk about that at length, and hopefully you'll understand them better as you read through the chapter. And I just wanted to kind of go over the three methods they discuss in the book. There are other methods of computing return on investment, but these are three very common ones. And so the three that they use in the book are, first, what's called the payback method. The second is called the net present value method. And the third is called the internal rate of return method, or just the internal rate of return. So I'm going to take you through the real very simple example that they give in the book for all three of these, just to give you an idea of how we calculate them and a little better idea of what they mean. So the first one is the payback method, and it's the simplest of all the methods. And really the formula is just the initial investment, or the initial cash outlay, the amount of cash you pay out, divided by the cash flow received from the investment per year. What's great about the payback method is it is super simple. It's just a division problem, so it's easy to calculate. It's also pretty easy to explain to someone what it means. The downside is it's so simple that it's too simple, meaning it doesn't tell us a whole lot, and I'll explain that more as I go through the example. It doesn't give us an overall return or tell us what our money is, and most importantly, it doesn't consider the time value of money, which means it doesn't consider the fact that a dollar I have in my hand today is going to be worth more than a dollar in a year if I just leave it sitting in the bank, earning interest in essence. And so I've got to consider that money earned in the future may not be as valuable as money I had today that I could invest for that whole time until the future. So because it doesn't consider that, it's not a very robust way of estimating, especially projects that are long-term in nature. So the example they give in the book is a company considering buying a $3,000 piece of equipment. They say it's a specialized computer. You expect the computer will last for 3 years, and at the end of each of the 3 years, the computer is expected to net the company an additional $1,300 in cash flow. So that seems like a no-brainer on its surface, right? We pay $3,000 for something, and it makes us $1,300 a year for 3 years. So that would be a net of $900 increase in that investment. And then it gives us the additional piece of information that our company has a required rate of return of 8%. And required rate of return is sometimes called a hurdle rate. This is, most companies get together with their accountants and their managers, and they figure out how much it costs them to borrow money and how much money they could be making if with other investments, and they set some minimum required rate of return, meaning they don't want to take on a new project unless it's going to make them at least a certain amount. And in this company's case, it's 8%. I will tell you, in the real world, it's usually much higher than that, 15 to 20%, depending on the nature of the business, but not always. Anyway, so how do we calculate the payback? It's simple. We just take the initial investment of $3,000 and divide it by the cash flow per year, which is $1,300. And so there it is, the initial investment, $3,000 divided by $1,300 per year, gives us a payback of 2.31 years. Like I said, the real pro of this is it's simple to calculate and it's easy to explain. You could sit in front of a boardroom full of people and you could say, look, it's going to take us 2.3 years to make back our money on this. And then, in essence, any period of time beyond 2.3 years, in this case they expect it to go 3 years, is going to make us a profit. And if we could stretch the life of it longer, then we're going to make more profit. So that's the payback method. Very simple, very easy to explain. Like I said, it doesn't provide us an overall return. We don't really know how much we're going to make on this. We just know that we're going to get paid back in 2.31 years. So there's the payback method. The second is the net present value method. Now this, you can tell just by looking at the formula for it, is a little more complicated. What that formula says is that we could calculate the present value, or what future money we'll receive in the future, what that's worth in today's dollars, by using this formula, which is the future value of money that we expect to receive, plus or divided by 1 plus the interest rate we're earning on it, plus the future value of the second cash inflow, divided by 1 plus the interest rate squared, third, or cubed, etc., until we go all the way out. And then we can find our net present value by taking the present value, which we calculated here, and subtracting the initial cash outlay. So the pros of this is that it does include that time value of money. It recognizes that money in future periods is worth more, calculates in the interest we're going to earn on them, and it considers the cost of the capital, the money we're going to have to put out in order to earn this money. And it uses the present value. It couches or frames everything in what dollars are worth today, even that future money. The cons is it's difficult to calculate, and like I said, it looks scary, but it's not that difficult, and I'll show you how to do it. It is difficult to explain when you try to explain to the bosses that this deal that doesn't look like a good deal is really a great deal because of the future value or the present values of the future cash flows. That can be confusing and makes it hard to explain. And then the other downside is, but this is the downside with all figures really, because we had to use estimates in the other one too. The first one we did, the payback, but it's based on estimates, right? We're guessing how much future cash flow this is going to bring in. About the only thing we know is how much we're going to have to pay out at present. But we are estimating everything else, what the cash flows will be in the future and how many cash flows it's going to bring in. Maybe it will last more than 3 years. Maybe it'll break after 2. Anyway, so those are really cons of all ROI or most financial estimates. You know, we have to, or most financial calculating where we have to use some estimates, and that's a downside. All right, so the same example, the company considering buying the $3,000 piece of equipment, $3,000 spent now, and then $1,300 made, or an increase of $1,300 each year for 3 years. And now we can figure in that 8% too. So here's what it looks like. The present value is the future value of the first period, which is $1,300 plus 1, or divided by 1 plus the interest rate, plus the future value of the second period. In this case, it's the same in each period, right? $1,300 is the future value we expect to receive for this investment. So we work it out, 1,300 divided by 1.08, 1,300 divided by 1.08 squared, 1,300 divided by 1.08 cubed, and that comes out to $3,350. Now to find the net present value, we take that present value that we've calculated, $3,350, we subtract the $3,000 initial cash outlay, and that leaves us with a net present value of $350. An important thing to understand is what this means. What it really means is that we were able to do better than our required rate of return of 8%. If we earned exactly 8% on this investment, then our net present value would be 0. So it's important to note that a net present value of 0 doesn't mean that you broke even. It means you earned exactly what the required rate of return was. Any negative amount on net present value would mean we did not achieve the required rate of return, and any positive value means we exceeded or did better than the required rate of return. So that's the net present value method. The third method that's presented in the book, and it's a common method, is called the internal rate of return method. This one, you'll notice I've got no formula for you, because even though the math isn't ridiculous, it is a little bit challenging, and it's kind of beyond the scope of what we're trying to learn in this class. We're not here to become accountants or actuaries or anything else. We're supposed to learn some tools that will help us as managers better understand our numbers. So the pros of the internal rate of return method are that it's fairly easy to explain, because what it does is, in essence, it tells us what the rate of return is as a percentage. And it doesn't, the cons are, it doesn't quantify the project's total contribution the way that net present value does, and it doesn't address the issue of scale. In other words, what that means is we could have two projects, one that makes us $1 million on a bigger investment, and another one that makes us $300 on a smaller investment, and they could technically have the exact same internal rate of return, but of course the one that makes us $1 million is probably a better deal if we have the cash to invest in it. Anyway, so one thing we can do with internal rate of return is we can make an estimate, right? Here's our same example. I could take a look, on the previous slide when we said we know we beat 8%, so we know that our internal rate of return is going to be greater than 8%. So I could estimate, and I've been doing this a number of years, so I would guess it's somewhere between 12 and 15%. So it is pretty easy to estimate. But we can use Microsoft Excel, and I'm going to show you actually now how to use Excel for all three of these examples. But we could use Excel and find that our internal rate of return was 14.36%. So in essence, if I invested $3,000 and then I made $1,300 a year for the next 3 years, what I'm saying is my rate of return on that investment is 14.36%, and I'll show you how to use Excel to calculate it. All right, so here I'm bringing it over as an Excel spreadsheet I started earlier. Let me shrink it down a little bit to make it easier for you to see everything. There we go. And I will increase the font size. All right, so here we see our same example, an initial cash outlay of negative $3,000, meaning we paid out $3,000. That was the cost of the computer. And then a cash inflow of $1,300 at the end of year 1, $1,300 at the end of year 2, $1,300 at the end of year 3, and a required rate of return of 8%. So the first one we want to calculate is our payback, or our payback period. And if you remember, the formula for that was simply to take our cash outlay and divide that by our annual cash inflow. So to do that in Excel, I'm going to say that this cell equals, and I have to use a function here that people don't always, know to use, and that is, it's called absolute value, ABS, because I don't want it to be a negative 3,000. I want the absolute value of negative 3,000. And then I'm going to divide that by the $1,300, which is 1 year's worth of cash inflow from the investment. When I do that, it's going to give me 2.31. It got confused and thought I was working in dollars, but I'm not. So 2.31. Present value, there's a formula, or a function I should say, in Excel. So I use equals PV for present value, parenthesis, and then I do the rate. So I just click on my rate, and then a comma, and my payment. Let's see. Oh, you know what? I'm actually going to use the net present value formula, sorry, NPV. And then what I do is I do the rate, and then I do value 1, which is negative 3,000. That's the amount paid out at the beginning. Value 2, which is 1,300 at the end of the first period. 1,300 at the end of the second period. 1,300 at the end of the third period. I close the parenthesis, and it's going to calculate it for me. Now you'll notice that that is a little bit different than what we got when we did it by hand. And the reason for that is that Excel rounds at every step of the way. So the Excel answer is actually more accurate, I guess would be a way of putting it, than what we did when we calculated by hand and we just took everything to 2 decimals and worked it out from there. So don't sweat it if you work it out. If I give you a problem and you have to work it out, I will accept either the hand calculated way or the net present value if there's a difference between the two values. And now the internal rate of return method. Again, there's a function in Excel called IRR. And for that one, all we have to do is we highlight our values. So the initial cash outlay of $3,000 plus $1,300 after 1 year, 2 years, 3 years. Close the parenthesis, and it's going to calculate what that is as a rate of, or as a internal rate of return. So we know that we're making 14.36% on that. Again, remember the pros and cons. Payback period, that's very simple to tell someone, look, it takes 2.31 years to get your money back. Net present value isn't so simple, but it does return us a dollar figure that's kind of valuable. We're saying, hey, for our investment of $3,000, we are going to earn at present value, at today's dollars, $3,324.28 or $324.28 in excess of our initial cash outlay through this investment. And then the internal rate of return is valuable because most of us understand percentage rates of return. We know that if we were to go to the bank today, we'd get less than 1% on a savings account or maybe only 1% on a certificate of deposit. And so we know that a 14.36% return is a pretty good rate of return. Anyway, so those are the 3 ways of dealing. Like I said, there are others, but these are the 3 covered in the book for ROI. The last thing I'll say, and I kind of alluded to it earlier, is the real challenge in all of this for all accountants ever is getting good estimates. Again, we usually know about how much we're going to have to pay in the cash outlay. That's not hard. What we don't know is exactly how much cash inflow and investment is going to make us in the future. We have to make an estimate. You know, when I bought my storage units, I knew how many units there were. I knew how much I was going to rent those units for, but I didn't know how occupied they would be. So in essence, I had to run a couple of different ROI forecasts using 100% occupied, 90%, 80%. I actually did from 50% all the way up to 100%. And when I found that I could make a profit as long as I was 60% occupied, that seemed like a reasonable risk to me. Anyway, so we have to have good estimates, and sometimes we have to, run more than one estimate as we do our ROI figures, just so we can get an idea of how good the investment is going to be for us. I hope this video was instructive for you, and I hope you enjoy the rest of this lesson. And I hope you're enjoying the class. I think this class really, for me, helps me think about money in a more tangible and doable way than an accounting class does. Yeah, I teach accounting and I love it, but I don't think the average manager cares that much about debits and credits, but they do care whether or not this investment is making them money or losing them money. And that's the idea. Anyway, good luck for the rest of the week, and good luck for the rest of the semester.